my name is Alan Godfrey. I am a CPA. I have been for about 30 years. Yes, I got lots of white hair, and keeping um, trying to keep busy. I've been implementing ERP systems for the last 28 years. I get last count, I was somewhere around 600 different organizations around the world. I'm quite new to the ESS group. I've only been here for about 2.5 weeks, but I'm really looking forward to spending some time getting to know all our client base and, of course, our team, and getting more and more familiar with the software. So I tried to come with a strong financial background. I'm also on the IT side. I do know SQL quite well. My wife calls me a double geek, and been that for a little while. Says when she tries to explain what I do, it's something with computers and accounting. I don't know. So it's but I love what I do, and I turned 60 a couple of weeks ago, and thought, nope, I'm not ready to retire yet. I still enjoy what I do, and it gives me an opportunity to get in front of people like yourself, and show some today we're obviously going through the basics of accounting, but we can go through anything financial at a later date for our wonderful software. So okay, so I'd like to go through basically what our objective of this webinar is. Sorry, I'm just going to. Okay, so what we're going to be learning today. So I'd like to be going through the general ledger, explain basically what the general ledger is. What is a GL account or a general ledger account? What is a debit? What is a credit? Looking at a debit and credit, a lot of people get confused what a debit and credit is by their banks actually seem to kind of mess them up. You look at your debit card, your credit cards, and so it really messes you up when you're trying to do a transaction and going, okay, is that supposed to be a debit or a credit, or when you're having to make that determination. A lot of ERP systems will automatically do the one side of the entry for you, but if you do just a regular GL transaction, you've got to kind of think about what it is that you're doing. So we're going to be talking a little bit about that. What is a chart of accounts? Obviously it's a collection of all of your general ledger accounts and labels and what their typical balances, what kind of account category, and so on and so forth. What is a trial balance? We'll go through that a little bit today and explain how that all kind of works and ties in. We're going to look at the 6 basic types of accounts or account categories. So we'll look at assets. What is an asset? Liabilities, owner's equity. Now, those first 3, generally you will always see in a balance sheet. And we'll be going through a balance sheet a little bit later today and see how that kind of all works. And then the flip side of that is the revenues. So revenues are sales, your cost of goods sold. We'll talk about cost of goods sold and how that works and what that means. And then our expenses. We'll get into some detail of expenses and how they all work. We'll also be going through some subledgers. So we'll look at the accounts receivable. What is that subledger? What does it look like? Accounts payable on the flip side of money that that's going out of our organization. And I also like to look at a bank rec is, it's not really a true subledger, but it is another, basically a process of transactions. So obviously it's related directly to your GL bank account and how that kind of ties in. But I do look at it as a ledger because there is a reconciliation that happens with that, and we'll go through a bit of a bank rec, a manual one, and just to explain the different components of that. Also fixed assets. Fixed assets are anything that you've purchased within your organization that's kind of a larger, when you're looking at determination of what a fixed asset is, generally the rule is, or my rule anyway, um, I look at the item that I'm buying. Okay, what is the price of it? $500, $1,000. Okay, now that expense that I just bought, what is the life of it? Am I using it up in the first week or a couple of weeks or something like that? Well, if that's the case, then I'll probably just expense it. If it's got a life of 10 years and it's got a price on it that's, a fair number, then you may want to put it in your fixed assets. And we'll talk about those and different categories within that. And then of course, SyteLine, we can track our fixed assets within the system, and depreciation. We'll talk about how depreciation works within the software, or some people like just to keep track of it within Excel. And then we'll go through a balance sheet, the different components of a balance sheet and how they come together, as well as a profit and loss or an income statement. They're basically the exact same thing, and how they kind of all tie together. Okay, just going to take a drink here. All righty, so let's get into this here. So what is a GL account? Well, a GL account, there's generally, hundreds of them within your organization. It's basically a way of, tracking all of your different areas, like as I said earlier about the account categories of all of your assets, your liabilities, owner's equity, revenues, cost of goods sold, and expenses. So each one has a specific account. We'll talk a little bit more of that a little bit later when we get into the account categories and how those GL accounts, work, and what the numbering of them is. We'll also talk a little bit about unit accounts as well, unit categories, and how they work with SyteLine. What is a chart of accounts? Well, it's just a complete listing of all your accounts that you're using within your GL. Generally, if you're, in accounts payable, for instance, and you're posting a lot of disbursements, you may take a portion of your chart of accounts related to expenses and have them up on your wall, ones that you use all the time if you're, fairly new to the organization. But you generally try to keep you don't want to just create, I had a client that had upwards around 300,000 GL accounts. It can get crazy. And some organizations, you have, or some software, you can have multiple segments to a GL account. So they would have the main segment of the account, and then they would have a segment maybe for department, a segment for location, a segment for products, and so on and so forth. The way that it works in SyteLine is a little bit different, and as I said, I'll go through that in a little bit. What is a trial balance? Basically, a trial balance is a report by time. So say that we're looking at the 10th of or 11th of December right now. We can say we're run it for the end of November of every single GL account I have in my system. Now, the total of all of those at the bottom has to be 0. If it's not, then you're missing an account or there's something wrong with that, because basically there's two sides to every single transaction. You know, when you look at buying something, you look at, you know, receiving some money, there's always a debit and there's always an offsetting credit to it. And that's why a trial balance, which is a collection of every GL account that you have in your system, basically adds up to zero. So that's how trial balances work. And then within SyteLine, you've got your Unicodes. Okay, now your Unicodes, generally the Unicode number 1 is tied into a department. So it could be payroll or shop floor or something like that within your organization, however it pertains. Our Unicode number 2 is for product, different product codes. So you can isolate those. So it's like another segment to your GL, but it allows for very easy reporting, and be able to isolate that data. So that way you know, hey, I know exactly how that department is doing or how that product is doing. You know, you can isolate different types of categories of your product and so on. And then we have Unicode 3 and 4, which are user defined. Basically, you can make them whatever you want. You know, I had said earlier, like a location, but you may have some other, you know, way that you want to keep track of things. Maybe the currency code or a vendor statistics or customer statistics or whichever kind of works best for you. So you've got that available. You don't have to use them. It's totally up to you, but that's a way of basically extending your GL account. Okay. What is a debit and a credit? Well, it's exactly a debit and a credit is, you know, if I'm looking at buying something, so um, the debit, you know, so say that I'm receiving some money. So the debit goes into my cash, and then the credit will go to something kind of offset. Maybe it might be, you know, revenue. It might be the maybe an expense that you're getting money back as a refund or something like that. There's always kind of a double side. So my example here, I got a double entry accounting, you know, records all the monies that are flowing in and out of the account. Now I take out a $5,000 business loan. So you receive the money. So that money goes into your assets, your bank account, or your GL account for cash. Um, but the offset to that, so the credit, is basically a bank loan. So there's a credit side to it as well. And, you know, so credit, bank loan, it's also considered a liability. I do have a number of other examples of that. We'll go through that a little bit later today, as well as I have in a document that I can send you all if you wish, going through many different transactions and showing the debit side, the credit, like how they basically would work. And so maybe a scenario that you may be looking for an answer for. Okay, so our 6 types of account categories. So, you know, as I said earlier, there's assets, liabilities, owner's equity, revenue, cost of goods sold, and expenses. So assets, what is an asset? Okay, well, generally in accounting systems, now I mean your chart of accounts is your chart of accounts and you can set it however you want, but in my travels, generally speaking, so if I have a 4-digit GL account, usually assets are between 1,000 and 2,999. It may be different in your organization, but that's kind of the general. So an increase of an asset is always a debit. So our examples of assets, well, we got cash, we got accounts receivable, prepaid expenses. Now, prepaid expenses are something that, you know, say if you had insurance for the year and say it was $1,200, you don't want to expense that in the month that you received it. You want to expense it in every single month as you march throughout the year. So what happens is when you do an entry for, say, insurance or property taxes, you can post it all to the asset of prepaid expenses. And then what happens is you do a journal entry, a monthly journal entry that will credit the prepaid expenses for the $100. And then it'll debit the expense for insurance in this case, as you're going through for each month, getting down to a zero balance. So that's kind of how that works. So liabilities, well, again, account numbers. So we got 3,000 to 3,999. An increase of a liability is always a credit. So our examples, of course, are accounts payable. We've got bank loans or like leases, tax payables. I mean, there's a whole different, there's a very long list of different liabilities. Maybe long-term investment, maybe, notes payable, or, there's many different accounts that would show up in your liabilities. Okay, what is an owner's equity? Owner's equity, again, with the accounts, say 4,000 to 4,999. That is also the increase of a owner's equity is considered a credit. So what is the owner's equity? That's a section that shows up in my balance sheet. Similar to assets and liabilities, it has a own little area. It has retained earnings. Now, basically what retained earnings are is just a collection of all of my sales minus my cost of goods sold minus my expenses. So it's basically the income sheet. So whatever the income statement is, so that net loss or net gain or whatever that number is at the bottom, that ties into the retained earnings. Now, generally in an accounting system, in your chart of accounts, you may have two different retained earnings. You'll have a regular retained earnings, which is your year-to-date amount that you have from your previous year. And then you'll have a current year retained earnings, which is the washout between those three account categories. And we'll go through that a little bit more when we go through an income statement a little bit later. Okay, so we've got retained earnings. Then we have shareholders loaned. So that's basically if an owner were to invest in the company or taking money out, maybe they're purchasing something on their own behalf. So that money flows in and out of that account. There's capital, there's different stock that you would also look at as well in the owner's equity. So these three categories basically make up the balance sheet. And we'll go through it in a little bit, but if you take your total assets, so whatever that total is, and then you take your liabilities and your owner equity, add those two together, that should total to your assets. So that's why they call it a balance sheet. So the first component of the assets, that total must equal to the total of the liabilities and the owner's equity. If they don't, then there's something wrong. So then you're missing an account. Maybe you create a new account and it's not showing up in your Excel spreadsheet for bringing in your financials and that kind of thing. But generally, that would be the issue. Okay, so the flip side, the other three we talked a little bit about is the revenue. So we got revenues, GL account 5,000 to 5,999. We got the increase of a revenue, so a sale kind of thing, is always a credit. So what are examples? Of course, we've got our sales, regular income, we've got, say, professional fees or disbursement revenue, or maybe interest charges or finance charges or something like that anything where you're basically making money for the organization. So that's considered obviously a revenue. Then you got cost of goods sold. Well, what is the cost of goods sold? Well, first of all, it's GL counts between 6,000 to 6,999, and then we're looking at an increase of a cost of goods sold is a debit, but what makes up cost of goods sold is things like shop labor or inventory changes or inventory purchases, anything related to. So say if you were a manufacturing company, you're going, okay, everything that I'm putting in to make this widget, all the pieces come together. So anything related to that, there may be some other expenses that you would bring in there as well. If you're in mining or something like that, there's some equipment, some depreciation, all that kind of stuff will go into the cost of goods sold. It's not part of your regular operations or administrative kind of expenses. So that's why they go into the cost of goods sold. So we will go through it a little bit later, but if we were to take the revenue minus the cost of goods sold, we would get a thing called gross margin. So that basically just shows us, okay, before I add in all of my other expenses, this is where I'm at. If you're not in a positive light at that point, then you've got an issue. Either you're not charging enough for revenue wise, income wise, on your products that you've produced or whatever you're doing, and your cost of goods sold is too high. So you look at that number and you go, okay, if I'm not getting at least 30% or more gross margin, because you do it as a percentage, then there's definitely an issue there. So it's kind of a quick math that you can do when you're looking at an income statement. And then we got expenses. Okay, so expenses are anything 8,000 through to 9,999. Of course, an increase of an expense is always a debit. And then we've got what is an expense? We got wages, rent, maybe subcontractors or, advertising and so on and so forth. We can break them up into different categories. Maybe selling expenses and administrative expenses and operating expenses, breaking them down, giving a little more detail to the income statement, whatever kind of works best for you. Some people like it nice, quick, dirty, not too much detail, but you don't want to throw every single GL account on there because it just gets way too cluttered. Just take a second here. Okay. So this is an example of just some transactions. So we've got our debits and our credits. So August 1, owner contributes cash, inventory, equipment. So we see we're doing a debit, cash for $5,000, equipment of $10,000. They threw a motor vehicle for $22,500. And then you got the capital. So those first three are all assets. Okay. So the first one is just your regular asset. And then the equipment and the motor vehicle, it would be fixed assets, but they're still showing up in assets. So the flip side of that is the capital. So the 37,500. So you may want to label as capital, and maybe also shareholders loan. It whatever kind of works best for you and your financial reporting. Then we've got a basic one of, say, advertising. Okay, I spent $1,000 on advertising for my organization. Maybe I created a website. Maybe I'm doing some kind of mail out or something like that. And then, so that is always a debit, as we talked earlier about expenses. An increase of an expense is always a debit. And the flip side is the money cost us. It cost us $1,000. So it hit my bank account, the asset of a credit of $1,000. So, I've just got a few different ones here. And we can make these slides available to you guys later. But I have like literally 3 pages in my document that we can send off to you later if you like. And it'll go through transactions like this and what is the debit and the credit, and just kind of helps maybe get a little bit better understanding of what to do. Because if you're sitting there and you're going, okay, is it a debit? Is it a credit? Like it messes me up. Like I had said before, sometimes when people think of banks, they go, okay, I look at a bank as a credit card, or I got a debit card. And I tell people, say, well, okay, say that you put $100 into your bank. Okay. Well, the bank looks at it as a liability to them. The bank is a business, just like how you are. So that $100 to them isn't an asset, it's a liability. It sits there because you are owed that money. They owe that money to you. So it sits there as a liability to them. Now, if they loan you money, then to that is something that is a kind of revenue to them, or long-term investment, and that. And then of course you owe the money to them. So it's just a matter of looking at it like they're a business and they have to record their debits and credits just like how you do in your business. Okay, subledgers. All right, so as I said in the onset, we've got our different subledgers. We got accounts receivable, which of course is our listing of all of our customers and transactions related to that. Our accounts payable, listing of all of our vendors and how we wish to pay them. We're going to go through a report for each of those a little bit later and talk a little bit more detail right away. The bank reconciliation, how does that work as a kind of a subledger? And then our fixed assets. We'll go through that in a little bit as well. Okay, so when I get the health of my accounts receivable, you run a report called a historical age trial balance or an age trial balance. Basically, it gives you a listing of all of your customers, and it gives you what we call buckets of different points of time. Okay, this is what they currently owe, and then there's 1 to 30 days, 31 to 60, and so on and so forth. So basically, in one little quick report, you can see exactly who owes you money, and if there's anything in the over 61 days, then you need to start making some phone calls. This is a summary, and then there's also a detailed one as well, where it'll go through each customer and it'll give you the listing, it'll give you the date of those actual transactions, and so on and so forth. So basically, when you are doing a revenue transaction out of your system, it'll automatically post the debit to accounts receivable, and there's a GL account considered a control account in the GL for accounts receivable. And when I say control account, it means that you and just in the GL side of things, not in the subledger, you can't post directly to that accounts receivable. The reason why is because if you're doing transactions in your subledger, and then all of a sudden someone starts hitting the GL account for the accounts receivable GL, it'll throw the numbers off because that bottom number, that $9,707.22, must tie in to the GL balance for the end of August 8th in my example I've got here. So they must tie in together. Always, always, always. Okay? So that's why we have these control accounts. We also have the similar type thing for payables. So what is payable? So we run basically a accounts payable, aging summary report or detail report. And it gives me a listing of all my vendors. And again, the same thing of buckets where you've got your current, 1 to 30 and so on and so forth. And of course, we can run it by detail, which allows me to see each individual one. Some people like to do their check run, so cutting checks. So you can do checks or you can do ACH or EFTs to your vendors out of SyteLine. And if you don't have that currently set up, we can help you with that. But then you basically from your trial trial balance of detail, you can decide, okay, I want to pay that invoice, or I don't want to pay that invoice, or half of this. With that, you can build kind of a check batch from that. Or within the system, you can set it up by due dates. So when you post that invoice of, say, December 11th, you set a due date of 45 days, maybe that's the term, or 30 days. So when you go to generate that check run, it'll automatically bring in that value of that invoice into it. And then you can decide if you want to pay it or not, but it's whatever works. So if that's an automatic way that you prefer it, or some people go this way and running an age trial balance detail to be able to generate what it is that they want to pay. Okay, bank reconciliation. Okay, so this is just kind of an easy one. Some people use the bank rec module within the system. Some people just prefer to use Excel. So I just want to go through what it looks like within a regular bank rec. So you've got your bank balance. So that's your balance that you get from your statement. And then there's always a timing difference between what your bank statement says and what your GL says, because you've got things kind of in transit. So in this case, we've got some 3 different deposits that are in transit. So then they add up to the $13,000. And then we have an adjusted bank balance to $119,800. And then we look at our GL, or our cash book balance, and then we look at the offsets to that. Maybe there's, as you see, a $200 for bank fees that haven't been posted yet because they were sitting on the statement. And so then that way the adjusted bank balance always matches to the adjusted book balance. And then you know that your rec is okay. So then you get additional reports. If you're using it within the system, you'll get a listing of outstanding checks within the system. And then, of course, a reconciliation of what you got. So it all depends on what works best for you. The next ledger is basically the fixed assets. As I said, I think it's about 50% or so from what I've seen is clients using the fixed asset module within SyteLine. Just to let you know, that information that you've got, maybe you've been keeping track of it in an Excel spreadsheet. We can import that into SyteLine to kind of get you going. So what is in this ledger? Well, we've got our assets. We label each asset with a certain number or whatever naming convention that you would have. Obviously, description, serial number, location of where it happens to be, what your purchase date was, who you bought it from, cost, what your depreciation method may be. So in Canada, say if you're looking at a vehicle, you're looking at 30% depreciation per year. If it's a heavy piece of equipment you're using for mining, that's at like 10%. So there's different rates for different items. If it's straight, like as this example here, where it's a computer, it's a straight line. When it says straight line, basically that just means, okay, I think the life of it is maybe 3 years or 5 years. You take that $499, divide it by that number of years, and then you'll get your rate worked out to there. So some people, like as I said, like to just track it all in Excel, and then they do an entry um, after that in your GL for your depreciation. So basically, the way that it works for fixed assets, and we'll talk a little bit about it in the um, when I go through the balance sheet because it isolates a little bit better. But when you always have two accounts that in the GL related to your asset. You got so say if I bought these computers and I say it cost me $1,000. So I would have a GL account for computers, and then I go $1,000 as a debit because as I said, the increase is always a debit. And then you have an offset of your what we call accumulated depreciation. So that means that each month, you're depreciating that asset by whatever depreciation method that you've isolated for it. So the total of the asset never changes. It always stays at $1,000 until you sell it, for salvage value or whatever, until you decide to basically get rid of it out of your system. So it stays as $1,000, but the value, the offset account for cumulative depreciation, that is what increases. So if I look at my asset, so maybe initially it may be $20 or $50, say, for the depreciation for that month. So I'll have my $1,000 and then I'll have $50. So my what we call net book value of that one asset is $950 at that point. So as you march around through the year, that accumulated depreciation number gets bigger. And of course, that number for the cost always stays the same. So that way you can always see what the life is. So you look at it like the whole listing now. So you'll have furniture, you'll have computers, you'll have equipment or like vehicles or land or whatever your different categories that you have for your fixed assets. So you'll have the main account, so it'll be like vehicles or whichever. And then you'll have that offset accumulative depreciation for vehicles, for furniture or whichever. And then showing the net of the net book value. Okay. He's going to take a quick drink here. Okay. So,
Just sorry, Alan.
yeah.
Is everyone? Can everyone see the screen? Can you just thumbs up if you can see the screen? Because we got a comment that
That's not
okay.
changing.
Uh, okay. Some people say that they cannot see the screen.
Oh, okay.
Um,
Let me stop my share and then I'm going to reshare.
yeah.
Um, sorry, sorry about that. That is that better for everybody? Can everybody see this one?
Okay, it's fine now. Everyone said that.
Okay.
Yeah.
Sorry that we went this far. I'm sure that it's probably tough for everybody.
Yeah.
So
Yeah.
yeah. Well,
Okay.
thank you for bringing it to our attention. Unfortunately, we're probably about three-quarters of the way through it, but um,
Mm.
I'll go through the slides again. And as I said, I can give you this screenshot of the basically a document with all the different slides in it. So that way you'll be able to kind of go through it yourself a little bit later. Okay, so balance sheet. So what is a balance sheet? We talked a little bit earlier when we first started. A balance sheet is basically a report that shows my assets, my liabilities, and my owner's equity. Some people, as I said, call it the capital of your business. You get different, terminology as you're going through it, but basically, assets are always assets. Liabilities are always liabilities. And some people like to call the third section different areas, but I usually call it owner's equity. Okay, so we talked about assets, what assets normally are. Now I've got a report here. Sorry. Okay, so this is a balance sheet that that I pulled off. So this shows what, a kind of a typical company's balance sheet would look like. So we've got our assets, we got our current assets, which are cash and accounts receivable. Inventory, of course, in manufacturing is a huge thing. Keeping track of your inventory, your prepaid expenses, investments, and so on. And then we always have our section of, fixed assets. So this is showing out the profit, the property and the different equipment, um, land and buildings, equipment, and this is what I was saying earlier about the accumulated depreciation and how that works. So sometimes you will have accumulative depreciation for each of the categories, or in this case, it's just one for all of them. Okay. And then you've got intangible assets, and then the offset again of the um, accumulative depreciation of that. Um, Generally, intangible assets are more things like goodwill within your organization. So, so say that if you're if you're a business, you decided to buy Teddy's Fabric, ink, and then with that came, 50 years of experience and a lot of customers and a lot of product lines and relationships with your vendors. Then you look at it and go, well, with that, there's this amount that the company's worth because I'm not just giving you a brand new company. I'm giving you something that's been around a long time. So that's kind of what goodwill's for, is you've come up to this value and then you kind of go through and depreciate it and say, okay, well, this goodwill is good for X number of years. And so that's kind of how that kind of works. So see, we've got our total of our assets on the bottom left, and then we've got our liabilities on the other side. So we've got liabilities. Of course, our current ones are accounts payable, notes payable, accrued expenses, deferred revenue. So I mean, basically, it's revenue that you basically haven't taken yet. You've decided to take at a later date. You got your long-term debt. A lot of times you get like mortgages in there, as other examples. So we've got our total of liabilities of 247,000. Then we've got our shareholders' equity or owner's equity. So then this is where our retained earnings is. Remember, our retained earnings is basically the net of, or the net loss or net gain that you have from your income statement. So your sales minus your cost of goods sold minus your expenses. So adding our liabilities and your shareholders' equity in this case, equals, of course, 472,100. So our balance sheet actually balances. So if there was something out between the two, like if you're in Excel and you've got it configured with SyteLine, and if you're out by some reason, it means that either you possibly entered in an account maybe twice and you got a duplicate happening, or somebody's gone in and created a new account within your organization and it hasn't been mapped out yet in Excel to be able to bring that information in. So that's usually the reasons why your balance sheet would be out. Okay, an income statement. Now this is just a quick and dirty one, but I just want to kind of show different kind of areas. So we talked about the three components. So our sales or our revenue, 1.8 million. In this case, we've got our cost of goods sold is mainly, our equipment. So sorry, our inventory. So we got our finished goods, goods for manufactured, what the total is. Maybe we're going to add some labor into that. Maybe we'll add some depreciation off of our equipment. Things like that would get added into the cost of goods sold. And then from that, we get a gross margin. So $710,000. So then we take that value and divide it by the sales. And then if we don't come up with at least 30%, then you're in trouble. So that means that either you're not charging enough for your sales side of things, or your cost of goods sold is you're basically spending too much for to be able to produce that finished good. And then we've got our section for our operating expenses. So we've got our sales expenses, administrative. You can break them up however you want, whatever kind of makes sense to you. Some organizations, inventory is a huge, huge piece of what it is that you're doing. So you want to have those numbers isolated in your income statement. You want to be able to make the whole point of having a balance sheet and having an income statement is to make it relevant information for the reader. So they look at it and it tells them something. Or if I look at the gross margin and I see that it's at $10,000 and not 710,000, then I'm going, okay, what's wrong here? What's going on? I haven't even added in, my selling expenses or my rent or, a multitude of other expenses. And I'm already just barely, making any kind of bit of a, gross profit or gross margin. So that's why I said these kind of reports can, really, really help you get that information that tells the state of the company, where the life of it is. So there's other financial reporting. You can make like cash flow reports, out of the system. There's a multitude of other ways to be able to cash position at a certain time. Basically bringing in numbers from, okay, I got my cash numbers. I've got my expected amount that, okay, I've got $1 million in accounts receivable. I figure in the next 30 days, I'm going to capture 25% of that or 50% of that. And so what does my cash almost forecast look like? So financial reporting can be great tools, so we can hand that information to the individuals in the company that make those decisions. Okay, so we're about 45 minutes in here. This is pretty much the presentation. I'm sorry that it came. I didn't know that the screens weren't advancing the way that they should. As I said, we can make it available for you to see all those different screens so that they actually do make sense. There was something that I was actually talking about. Here's my email address. If you guys have any questions related to the finance side of things of SyteLine, I can definitely help. I believe you had a couple of questions there, Con.
Right now, I don't see any questions, but
Okay.
we're at the Q&A section right now, and this is your chance to ask any questions you have about topics. No question is too big or small. We're waiting for your questions. Okay, we have one
I think I
question.
put everybody to sleep. I know accounting is such an exciting thing, so.
Okay, we have one question from Matt. How does the result of the income statement flow into the balance sheet?
How does it flow from the income statement to the balance sheet?
How
Okay.
does the result of the income statement flow into the balance sheet?
Yes. Well, basically if you look at the revenue or the sales minus the cost of goods sold minus the expenses, all the expenses, you're going to get your, you're going to get, um, excuse me, your income from operations, or some people call it profit, net loss, net gain, so on and so forth. That total ties back to the balance sheet of your retained earnings. That's how they kind of tie together. So every single one of these things that you look at, so your sales, cost of goods sold, expenses, every single one of these are GL accounts. Okay. So you can basically go in you could look at your trial balance and look from your very first sale number all the way down to your last expense number. That should come up to what your net loss or net gain is. That number, when you're tying it back to your balance sheet, that number should show up either in your current retained earnings or your retained earnings once you do your year end. Okay. Because right now, if I were to look at all my accounts, so all the 6 categories of assets, liabilities, owner's equity, sales, cost of goods sold, and expenses, so every single GL account, that's why they always add up to 0. It's because you've got transactions, as I said earlier, you've got money coming in. So you've got cash is being deposited as a debit, and then you've got the offset of, say, $100 going to sales as a credit, because an increase of an asset is always a debit, increase of a sale is always a credit. And that's why I think sending these screens to you guys, as well as the examples, it may help clarify some things for you. And as well, I'm here if you've got my email address, and we'll give it to you as well, if you didn't have a chance to write it down, and then we can go through it together, and I can help you with that.
Okay, and Narendra said we have started going over the financial workflow and moving the customer order from inception to the invoicing. And so far, don't have any questions, but yes, if you will have it, we will send it to the Alan Godfrey email ID. Thank you so much, Narendra. And Caroline, I don't have a question, but wanted to say thank you, Alan. Very informative. And welcome to ESS. Thank you also, Khan. Thank you, Caroline. Thank you for this
Thank
great
you.
comment. We still have 5 minutes, so if you have more questions, please don't hesitate to ask. Actually, when we have time, Alan, I just want to ask, maybe you can explain briefly what other types of financial reports can we generate in Excel,
Well,
as a last.
basically what you're looking to try. I mean, you can even generate a trial balance if you wish. Some organizations will, you'll be able to run. This is the really nice thing about the GL account with Unicodes, is because then within Excel, you can break it down to maybe your product types or your location, like your departments and that kind of thing. So you can run your report based on, you want to run a profitability report on a certain segment of your sales, of your products that you have in your organization. If you've broken it down that much in your GL, then you can basically isolate that. So it's more than just a balance sheet and income statement. As I said, there's a cash flow, and then you can break it down, the revenue, into your different departments that you've got going, and you can see where those numbers are coming from, breaking it down to whatever your product types are and categories, as well as whatever you've decided to use for the user defined unit code number 3 and 4. So you can break that revenue down, however, revenue or expenses down into each of those categories as well. So that's kind of where the power comes from. The data's in there. It's just a matter of how do you want it? How do you want to bring it out? I
We
just
have two more. Sorry.
I just wanted to say one thing as well is I have this thing called nice to haves and must haves within an organization. Okay. So, when I talk to clients, I'd say, maybe you've been using the system for a number of years and, maybe it was 5, 10 years ago. So maybe that initial training that you had has now been gone, or maybe some of the individuals may have left. And now, so you've come into a position, you're looking at the software. Okay, you've gone to N4, and N4U and tried to learn the software, but it's N4U is great for functionality and how to click here and so on and so forth, but it's not your data. It's not your customers, it's not your vendors, it's not your products. So, unless you have a play environment to go in and kind of test things, you know, training can be a big help. So this is where we can come in. So as an organization, obviously I'll be focusing more on the finance side of things. So I can come in, have a one-to-one or one-to-many training session with you guys, spending an hour or a couple of hours, and we can go through, GL, AP, AR, whatever focus it is that works best for you. Because the idea is, I mean, you've already spent the money. The money's already there that you've spent. You've got a tool now that maybe you're only using 30% of it. There may be modules that you don't even know that you have. So, one of the things that I like to do is have that temperature check with customers and say, okay, like let's walk through your systems. Let's walk through your processes. Maybe your processes have changed since go live. Maybe you've added on new companies, maybe you add on new processes, or you've added on new locations. So the way that you do business has changed. So you want to be able to utilize that tool you've got in front of you to its fullest. And that's what we can do. That's as our team, we can focus on your needs, your processes, and let you utilize the software better.
I think I'm seeing we are running out of time, but we have two more questions, Alan.
Okay.
I want to cover them too. When you affix overhead and labor costs to the cost of manufactured goods, does SyteLine factor in that overhead and labor are costs paid already, utilities, rents, wages, and subtract them from cost of goods sold when the goods are sold? Not sure if you answered this already, as I stepped away for a brief moment. From Joseph.
Okay, Joseph. Good question. Thank you. Now it's however you want to have it set up in your system. So if you're looking at your income statement, your cost of goods sold section, so when that entry is being done, it's a matter of are you hitting the right distribution accounts? We can look at it. We can spend 10 minutes together and look at it and going, okay, what is the flow of those transactions? Are they hitting every distribution account or expense account that you wanted to be able to hit? And then, of course, once it's done correctly, then obviously the reporting is the easy side. We can make sure that the reports are set up.
Okay, thank you. And one more question from Matt. Since you mentioned year-end, what does it to do all these accounts?
Well, with year end is kind of its own little animal per se. So, with regards to year end, you know, in your accounts, your anything that's sitting in the balance sheet always is when you run a report for it, your balance sheet is year to date. So So if I were to run it today, then I would get all of the balances of everything that happened today. In my profit and loss statement or income statement, that's just when I say year to date, I mean from the very beginning of life of your organization to today. Okay. Now the income statement or the profit and loss is just this year. So all of those accounts for sales, revenue, expenses, cost of goods sold, those values that got posted to those accounts for 2024, however your fiscal year works, they get washed out to zero, and that balance gets dropped into the retained earnings. That is the entry that happens. So when you start your first day of your new fiscal year, all of those accounts are sitting at zero. But of course, you always have those full balances sitting in your balance sheet. And that's how it works.
And the last question, is it possible to use more than one cost type in the same period through SyteLine? It seems it only allows to use on one cost type.
I'm not sure about that. As I said, I've been with the organization for 2.5 weeks. So I've been implementing another ERP system or a couple of different ones over the last 28 years. So I'm still learning some of the nuances of SyteLine. So I can definitely do research on that for you and get back to you with an answer. But there's some components of the software on how this hits versus that's I'm still learning.
Oscar, I actually encourage you to follow up with us afterward, so we may answer your questions. Okay, it seems like we don't have any more questions, Ellen, and thank you so much for this great presentation. It was definitely very informative and very valuable for everyone. And thanks everyone for being such an engaged audience. You're being an engaged audience today. And your questions are incredibly valuable, and we appreciate your time. And have a great day. And thank you so much. We will send you the webinar recording in very soon. Thank you so much.
Great. Thank you so much. Enjoy your day. And nice
Enjoy your day.
meeting you
Thank
all.
you.
Bye-bye.